Diversification involves reducing risk by investing in a variety of assets, while portfolio theory provides a framework for constructing a portfolio that maximizes return for a given level of risk. These concepts are crucial for minimizing risk and achieving desired returns, making them essential for effective risk management and optimal investment strategies. Diversification offers significant benefits, including risk reduction by spreading investments across different assets, reducing the impact of any single asset's poor performance. Combining assets with low or negative correlations can lower overall portfolio risk, potentially leading to higher risk-adjusted returns. The correlation coefficient measures the relationship between two assets' returns. A coefficient of 1 indicates perfect positive correlation, 0 indicates no correlation, and -1 indicates perfect negative correlation. Diversification is more effective with low or negatively correlated assets, as they reduce overall portfolio risk. Let's calculate the correlation between two stocks' returns. We load historical stock price data, calculate daily returns, and compute the correlation coefficient. Visualizing the returns with a scatter plot helps understand the relationship between the two stocks. Modern portfolio theory, MPT, developed by Harry Markowitz in 1952, aims to maximize return for a given level of risk or minimize risk for a given level of return. The efficient frontier represents a set of optimal portfolios offering the highest expected return for a given level of risk. Key concepts in MPT include expected return, standard deviation, and correlation. Constructing an efficient frontier involves calculating expected returns and standard deviations for individual assets, determining the correlation between assets, computing the expected return and standard deviation for various portfolio combinations, and plotting the efficient frontier. This helps identify the optimal portfolios that offer the best risk-return trade-off. The Capital Asset Pricing Model, or CAPM, describes the relationship between systematic risk and expected return for assets. It assumes that investors are compensated only for systematic risk, which is the risk inherent to the entire market. Let's calculate the expected return of a stock using CAPM. We load historical stock and market return data, calculate the stock's beta, and use the CAPM formula to compute the expected return. Visualizing the security market line, SML, helps understand the relationship between risk and expected return. Let's optimize a portfolio to achieve the highest return for a given level of risk. We define the objective function, for example, maximize Sharpe ratio, use optimization techniques like Monte Carlo simulation to find the optimal weights and evaluate the optimized portfolio. Visualizing the efficient frontier and the optimal portfolio helps understand the trade-offs involved. Diversification reduces risk by investing in a variety of assets. Modern portfolio theory, MPT, provides a framework for constructing optimal portfolios. The Capital Asset Pricing Model, CAPM, describes the relationship between systematic risk and expected return. Python facilitates the calculation, optimization, and visualization of portfolios, providing valuable insights for effective investment strategies.